Hello everyone, welcome to this 8-day session of FEMA as an extensive course. Organized by the Committee of Economic, Commercial Law and Economic Advisory by Institute of Chartered Accountants of India. In her budget speech, Nirmala Sitharamanji mentioned that we'll be able to take India to 5 trillion economy with Sabka Saath, Sabka Vishwas and Sabka Prayas. Sabka Prayas is what is expected by each one of us. And the government places a huge responsibility on every one of us to do this Sabka Prayas to facilitate everything between the government and the general public. With the increasing FDI in India, which was as on 31st December 21, we had received 17,933 million USD. And the way this USD comes in India is through the role of professionals like chartered accountants and company secretaries. So it is on us to understand and guide the companies, the clients, to understand this law and to implement this. Therefore, we have come up with this extensive and very elaborate and thought after course on Foreign Exchange Management Act, which regulates the foreign exchange transactions in India. The Committee of Economic, Commercial Laws and Economic Advisory is one of the non-standing committee of Institute of Chartered Accountants of India, constituted in line with one of the Institute's objective, partners in nation building, with a vision to contribute to economic development of India and to study the various economic and commercial laws, rules, and regulations. And to understand today's basic framework of Foreign Exchange Management Act, we have a very learning speaker, Company Secretary Sunil G. Nanal. So he is MCOM with distinction, fellow member of Institute of Company Secretaries of India, and he is also insolvency resolution professional, and he is partner with Kanj & Company LLP of Company Secretaries. And he secured 10th rank in final examination of CS Institute and was conferred with Pandit Nehru Sanitary Award for securing highest marks in the subject of corporate laws and practice, I think paper second. And he's been practicing in area for more than 20 years. So thank you, everyone. We have more than 1,000 members already joined in, and for everyone to join in today. And thank you, Sunil Nanalji, to join us today. And I would request to have the formal introduction of Sunilji now. Thank you.
Thank you, Sudhaji, for the nice introduction. Should we start with the session?
Rupali will be doing the formal introduction. I think we'll start with the session,
yeah.
Sunil.
Yeah. Yes. Thank you, Sudhaji. So at the outset, I would like to thank Dr. Rajkumar Adukia for giving me this wonderful opportunity, and all the committee members of Economic Commercial Law Committee of ICAI. I'm really honored to be the opening batsman of this series. I also congratulate all the participants who have decided to join this program. And I'm sure that at the end of the program, there will be many takeaways for all of us. And this is going to be, because this program is structured so wonderfully that it is capturing all the important aspects of FEMA. And so today, I'm going to start the session with the basic regulatory framework under FEMA. So many a times when I interact with fellow professionals, a question is often asked that how one should approach mastering the provisions of FEMA, or if suppose you are dealing with any matter under FEMA, how to make sure that whatever you are reading is the latest one and updated one, and the view based on which you are forming a view, whether it's correct or not. So today we are going to discuss all that into our session. So we are going to have the discussion on the regulatory framework under FEMA, then deliberate on the important definitions under FEMA, and analyze and also understand how to analyze capital account transactions, current account transactions. And once that is over, For another 1 hour, we are going to discuss on the all aspects under liberalized remittance scheme. So that's going to be the total objective of today's 2-hour session. And LRS, we are going to discuss with 13 practical case studies. So I'm hopeful that after the session, most of the doubts under LRS would be cleared. So once my presentation is over, then we can have a question answer session once the entire session is over. So I'll start with my presentation now. Yeah. So if one has to understand the provisions of Foreign Exchange Management Act, an entire gamut of the provisions with respect to FEMA, we need to go through the Foreign Exchange Management Act 1999, then the regulations framed thereunder by the Reserve Bank of India, then the rules framed by the central government, then RBI comes out with directions issued to the authorized persons, which are APDI circulars. Then there are notifications which are issued by the Reserve Bank of India to modify the regulations. And thereafter, RBI also comes out with the master directions, which compiles all the relevant changes made, all the provisions with respect to that particular topic, and all the relevant changes made by way of either APDI circulars or by way of notifications. And that compilation is available on the Reserve Bank of India's website. And in addition to that, RBI also comes out with the FAQs on different topics. And once we go through that FAQ, one understands what are the views of Reserve Bank of India with respect to particular query, because always there are certain gray areas where we interpret in a different way and the RBI stand is in a different way. So there, FAQ helps us to understand what at present RBI stand is on that particular topic. And accordingly, after going through these provisions of Act, the regulations, rules, and then APDI circulars, notifications, master directions, and FAQs, we can very well make sure that whatever conclusion we are drawing will be the correct one. And so that once we cover all these aspects, we can very well conclude that we have gone through the relevant provisions with respect to that topic under FEMA properly. So as I mentioned, that all provisions with respect to the Foreign Exchange Management Act are properly given and very well given by Reserve Bank of India. It's a beautiful site, www.rbi.org.in. And if one logs in on frequently on this website, you can very well come to know what are the latest updates on this website with respect to a particular topic under Foreign Exchange Management Act. So this RBI website provides under the head notification, which is on the left side, all the important notifications, all the other notifications issued under Foreign Exchange Management Act. It also comes out with the master directions on different topics, like master direction on commercial borrowings, master directions on foreign direct investment. So all important topics, master directions have been issued by the Reserve Bank of India. And once we go through the master directions, and so in the master directions also, once we click on a particular topic, you can very well come to know that up to which date that particular master direction has been updated. So basically, it's a compilation of all the provisions with respect to that topic and compilation of all APDI circulars issued by Reserve Bank of India with respect to that topic under the master directions. So once you have gone through the master directions, you can very well conclude that up to that date, which is mentioned in the master directions, you have read the provisions. And then if you want to go back to the respective regulation and the provisions under Act or rules, you can go back through this master directions and find out where exactly the origin of that particular provision is, or particular, like for example, ECB, or for example, a foreign direct investment. So exactly which regulation you should refer or which rule you should refer. So it's a beautiful piece of this thing, the master directions, where all the provisions with respect to that topic is covered. And then if at all there are any changes after the master directions have been updated, let's say now here in this example, the master direction on ECB is updated up to April 12, 2021. Then what, as a student of FEMA, we need to do is we need to only go through the notifications which have been issued after April 12, 2021. And once we update with that, what if at all any notification has been issued, then we have to just modify after going through that notification, what all changes have been made. And then we can very well make sure that whatever we are reading is updated one. So what I have done is, because the provisions under Foreign Exchange Management Act with respect to various topics have been given in different rules, different regulations. So many a times what happens if you are reading a particular, let's say you are reading provisions with respect to borrowing, or you are reading provisions with respect to lending by a person resident in India from person resident outside India. So we are not aware whether we have to read only foreign exchange management, borrowing and lending regulations, or there are certain other things also which we need to read. So what I have tried to done is, important topics, and with respect to that, I have captured all relevant rules, regulations under that topic, and I am going to share this presentation with you. So for example, here, if you have to go start reading provisions of Foreign Exchange Management Act and current account transactions and import and export related provisions. So one must read the provisions of FEMA Act, find out what is the definition of export, what is the definition of import. Then we need to read FEMA Current Account Transaction Rules 2000, Export of Goods and Services Regulation 2015, Manner of Receipt and Payment Regulation 2016, then Master Directions on Exports and Master Direction on Imports. So once we have gone through all these provisions, then we can very well conclude that whatever is there under FEMA with respect to these topics, I have been properly read. And then you can form your opinion and accordingly advise your client or carry out a particular transaction. So similarly, with respect to issue of shares to person resident outside India and license office, branch office, and project office, the list of regulations and rules have been provided. So the important 6 topics which are applicable in our day-to-day consultancy or day-to-day advisory, I have captured those. Like I was mentioning with respect to borrowing, if a person is in India is borrowing from person is outside India, so obviously we'll go through foreign exchange management, borrowing or lending regulations. But if there is some guarantee part in that, and where guarantee is being given or received from person resident outside India or given to person resident outside India, then we have to also refer to FEMA Guarantee Regulations 2000. So that's why what I've done is, with respect to that important topic, I have captured these regulations and rules at one place. So if you are referring to a particular topic, and if you want to understand what all exact provisions are there under Foreign Exchange Management Act, then this listing of regulations will be helpful to you. So likewise, there are 6 important provisions which I have captured. So now we'll come to the understanding of regulatory framework of Foreign Exchange Management Act. And as everyone is aware, the basic objective of FEMA is facilitating external trade and payments, and also for promoting the orderly development and maintenance of foreign exchange market in India. So unlike FERA, which was where the objective of government is to conserve the foreign exchange, regulate the foreign exchange, here under FEMA, because of the liberalization and as we had more foreign exchange reserves, now the focus is on the controlling the foreign exchange and managing the foreign exchange. So, and the drastic change as compared to FERA in FEMA is that under FEMA, the offenses or non-compliances are of a similar nature, which are punishable with monetary penalty. So we are going to have a separate session on that. And under FEMA, however, it was a criminal nature offense, which was punishable under with imprisonment as per the Code of Criminal Procedure. So this is an absolute. So governments stand diluted on with respect to foreign exchange, where from conservation of foreign exchange, government has moved to control of foreign exchange, and now government is only managing foreign exchange. And if at all any non-compliances are there, then there is only a monetary penalty, and there is no criminal unless there is an issue of money laundering and all, for which different acts have been enacted. And under FERA, there was a presumption of mens rea. So unless proved, the person is treated as guilty. However, under FEMA, the burden of proof lies on the enforcement agency. So that is also a good shift, where now, so the burden of proof is on the agencies and not on the person to prove that he is not guilty. So this was, with this objective, FEMA was introduced on 1st of May 2000, and for now, almost for 22 years, it is into effect. So with respect to regulatory structure of FEMA, the name of the act is Foreign Exchange Management Act 1999, and as I mentioned, it was effective from 1st of May 2000. In FEMA, there are total 49 sections, and out of which 8 are omitted, so actual are 41. And out of that, 12 sections cover operational part, And all rest of the sections deal with contraventions, penalties, adjudication, appeal, enforcement. So if you look at the actually length of the section, the act, as compared to Companies Act and many other acts, the act per se is very small, but all details are with respect to the provisions under FEMA lie in the rules and the regulations. So because there are only, as far as the operating part is concerned, only 12 sections are there, the opening sections of FEMA, which cover operational part, and rest of the sections are dealing with contraventions and penalties. So with respect under FEMA, the authority has been delegated to Reserve Bank of India and central government with respect to different matters, which we'll discuss, on which they can come out with the regulations and rules. So Section 47 of Foreign Exchange Management Act grants power to Reserve Bank of India to make regulations on various topics, and the authority is delegated under Section 47. And presently, RBI has come out with 26 regulations, which are basically regulations on permissible capital account transactions involving debt instrument, the period within which the manner of repatriation of foreign exchange is received, then limit up to which any person may possess the foreign exchange, and export, import, or holding of currency or currency notes. So there are different topics on which RBI has been given authority to come out with the regulations, and that authority is given under Section 47 of Foreign Exchange Management Act. And at present, there are total 26 such regulations. Thereafter, there are total 8 rules. So where Section 46 subsection 2 read with Section 5 of FEMA grant power to central government to make out rules on current account transactions and the instrument which are determined to be debt instrument under 6.7 and permissible capital account transaction under Section 6.2a and compounding provisions. So with respect to that, RBI has come out with total 8, the central government has come out with total 8 numbers of rules. So as a student, we have to go through the provisions of Foreign Exchange Management Act with the total 49 sections, then 26 regulations, and then 8 rules to understand the provisions with respect to Foreign Exchange Management Act. Thereafter, under Section 10.4 and Section 11.1 of FEMA gives authority to RBI to come out with general or special directions for the authorized persons who are allowed to deal in foreign exchange for the purpose of securing compliance of the provisions of Foreign Exchange Management Act. So Reserve Bank of India further delegates this power to the authorized persons. We'll see who are the authorized persons and what is the definition of FEMA with respect to the authorized persons. And in addition to those APDR circulars, RBI comes out with the master directions on the different topics, and the authority to come out with the master directions is given under Section 10 subsection 4 and Section 11.1 of the Foreign Exchange Management Act. So as we discussed, the master directions are nothing but compilations of the provisions with respect to a particular topic, along with the amendments made on from time to time by issuing the notifications with respect to that regulations or by issue of APDR circulars. So master directions are the compilations of the provisions of a specific topic, be it let's say external commercial borrowing or foreign direct investment or overseas direct investment. So for on different topics, RBI comes out with master directions. So this was actually a regulatory framework where there is a section, then there are regulations where the RBI has been given authority to come out with the regulations on different topics. Then there are authority to central government to come out with the rules. And then there are APDR circulars issued by Reserve Bank of India and master directions issued by Reserve Bank of India. So now we will discuss the important definitions under Foreign Exchange Management Act, which one should understand clearly before applying the provisions of Foreign Exchange Management Act to a particular transactions. So Section 2, subsection C defines authorized person means an authorized dealer, money changer, offshore banking unit, or any other person for the time being authorized under subsection 1 of Section 10 to deal in foreign exchange or foreign securities. As I mentioned, Reserve Bank of India delegates the authority or the power to the banks or authorized dealers, full-fledged money exchangers, restricted money exchangers to deal in various types of transactions under Foreign Exchange Management Act. So with respect to that, these category of people to whom the authority is delegated to deal in the foreign exchange or foreign securities are treated as, are defined as authorized persons. And in authorized persons, there are different categories. First is authorized dealer category 1, so which cover all the commercial banks, state cooperative banks, urban cooperative banks. So basically, category 1 authorized dealer, they have got permission to carry out all current account and capital account transactions which are permitted under Foreign Exchange Management Act. So entire authority is delegated to deal in all type of current account and capital account transactions. That category is known as authorized dealer category 1. Then the second category is authorized dealer category 2, which normally consists of upgraded full-fledged money exchanges, cooperative banks, and rural RRBs. So basically, category 2 authorized dealer, they are allowed to carry out specified non-trade related current account transactions, plus all activities which are permitted for FMCs, that is full-fledged money changes. And there are category 3 authorized dealers, which are select financial institutions and other institutions. They are authorized to carry out only limited transactions which are incidental to the foreign exchange. So whenever we read provisions with respect to FEMA, we'll always find that the reference of category 1 authorized dealer is mentioned, because this category of authorized persons are permitted to carry out all type of current account and capital account transactions. So these are the authorized persons through whom Reserve Bank of India carries out or regulates all type of foreign exchange transactions, either inflow of foreign exchange or outflow of foreign exchange. Then there is a category of full-fledged money changers. So basically, these are the entities, Department of Post, urban cooperative banks, and other full-fledged money changers, which are allowed to purchase and sale of foreign exchange for private and business visit abroad. So the RBI allows them a specific license to carry out only specified transaction which pertains to purchase and sale of foreign exchange only for private and business visit abroad. So if there is a requirement of any foreign exchange for any other purpose, then a person is required to approach authorized dealer category 1 authorized person. And full-fledged money exchanges, they are allowed to carry out on purchase and sale of foreign exchange only for private and business visit abroad. And there's the last category, which is restricted money changes, which are to whom RBI has given such license of RCMC, which are allowed to only sell foreign exchange for private and business visit abroad. So when we talk, when the word authorized person is used, it covers authorized dealer category 1, authorized dealer category 2, authorized dealer category 3, then full-fledged money changes and restricted money changes. So RBI through APDI circulars regulates or issue necessary directions to these authorized person and for implementation of Foreign Exchange Management Act. Thereafter, important definition one must understand is capital account transaction, because it is very, very important to whenever we are applying the provisions of FEMA with this to a particular transaction, cross-border transaction, we should be very well, we should make sure that we are properly categorizing that transaction as capital account or current account. Because if we fail to categorize it properly, then we might look into a different rules or different regulations and conclude that a particular transaction is allowed or particular transaction is not allowed. Therefore, the understanding of the definition of capital account transaction and current account transaction is very, very important. So this is the premise of the Foreign Exchange Management Act. And one must understand whether a particular transaction is a capital account or a current account. That's why we are going to spend a little more time on these two definitions. So capital account transaction means a transaction which alters the assets or liabilities, including contingent liabilities outside India of person resident in India, or assets or liabilities in India of person resident outside India. So basically, any transaction where there is which is entered by a person resident in India with a person resident outside India, which alters the assets or liabilities, including contingent liabilities outside India of person resident in India, or assets or liabilities in India of person resident outside, that is treated as a capital account transaction. So we are going to discuss in detail by having various examples. And also includes, so this is an inclusive definition which says includes transactions referred to in subsection 3 of section 6. And there is a recent modification where section 6 subsection 2 permits Reserve Bank of India to come out with the regulations on capital account transactions in consultation with central government, the transactions involving debt instrument. And Section 6(2)(a) allows central government to come out with the rules on capital account transactions, which are not involving debt instruments. So basically, there is a bifurcation of the authority under FEMA now. And with respect to the debt instruments, the authority is with the central government under with the Reserve Bank of India under Section 6, subsection 2. And the capital account transactions which are not involving debt instruments, the authority now lies with the central government. So under Section 6(2)(a). So per se, we will go back to the definition. So what it says, capital account transaction means a transaction which alters the assets or liabilities, including contingent liability, outside India of a person resident in India. So I have tried to basically capture the Schedule 3 or the financial statement of a company and try to analyze or apply a respective regulation or capital account transaction with respect to that particular transaction. For example, if we look at the liability side of the balance sheet, though it starts with the shareholders fund, and in share capital, there are equity shares, and if equity shares are issued to person listed outside India, and if you apply the definition of capital account transaction, so basically it alters the liability side of a person resident in India because the shares have been issued to person resident outside India, and it creates a liability, so that amount becomes payable to person resident outside India. So from the applicability of definition, equity shares to person resident outside India becomes a capital account transactions. So now, once we know that a particular transaction is a capital account transaction, we need to find out exactly under which regulations or under which rules that particular capital account transaction has been, the provision with respect to that particular capital account transaction has been provided. So for example, with respect to equity shares, as we predominantly know, it is treated as a foreign direct investment, or there can be issue of shares on a non-partition basis. And provision with respect to that is covered under foreign exchange management non-debt instrument rules. So similarly, issue of compulsory convertible preference shares, the provisions again are provided under foreign exchange management non-debt instrument rules. Non-convertible preference shares to person resident outside India. So there, even though from the Companies Act point of view, a company has issued preference shares, from FEMA point of view, non-convertible preference shares constitute debt. So provision with respect to that is provided under Foreign Exchange Management Borrowing and Lending Regulations 2018. Similarly, optionally convertible preference shares to person resident outside India. That also, because there is an optionality clause and these are not compulsory convertible, such issue of preference shares, even though under the Companies Act, it comes under the share capital. From FEMA point of view, it is a capital account transactions where provisions of Foreign Exchange Management Borrowing and Lending Regulation is applicable. So similarly, I have tried to capture all further this thing. So if suppose there is a profit, so profit is generated out of the basically activities of the company and it becomes payable. So the general reserve and profit and loss account will form out of foreign exchange management current account transaction rules. Money received against share warrants, money received against convertible instruments. Again, the provisions with respect to that, because share warrants and convertible instruments will be converted into share capital, the provision with respect to that is given under foreign exchange management non-debt instrument rules. Share application, money pending allotment received from person resident outside India. Again, all this money is received and that provision with respect to that, within how many days it should be allotted, and if not allotted, when it should be refunded. That is given under foreign exchange management non-debt instrument rules. So coming back to the definition, that means if a particular transaction is altering your asset position or a liability position, and if that transaction is entered with a person listed outside India, then such transaction will be treated as capital account transactions. So while coming down to the current liability portion, so long-term borrowings, a rupee loan from person listed outside India. So the moment you take rupee loan from a person resident outside India, it creates liability, it alters your liability position, and that amount is payable to person resident outside India. So it will become a capital account transaction. And the provision with respect to that is provided in the foreign exchange management, borrowing and lending regulations. With respect to foreign currency loan from person resident outside India, again, it will come under borrowing and lending regulations. Non-convertible secured debentures, non-convertible secured debentures issued in compliance with SEBI norms, and deposits from NRIs, that will come under foreign exchange management deposit regulations. Interestingly, the current liabilities. So as per the current account transaction rules, if you are importing any goods, then that transaction is required to be settled within 6 months. So as long as your liability is within 6 months, that remains a current account liability. So even though from the definition of capital account perspective, it is changing or it is forming part of the current liability, still, because that is settled within 6 months, that will be treated as a current account transaction. So trade payables to person resident outside India will form, which are payable within 6 months, will be a current account transaction. However, if there are trade payables to which a deferred payment has been provided, arrangement has been provided, so there we need to also comply with foreign exchange management, borrowing and lending regulations 2020. So likewise, from asset side also, if you apply the definition of capital account transactions to the asset side, if an entity in India is purchasing an immovable property outside India, it is going to alter its asset position. And with respect to that, because the immovable property is located outside India, we need to see exactly which capital account transaction, which regulation is applicable, and then accordingly see whether a particular transaction is permitted or not permitted, and accordingly conclude on the compliances to be made under Foreign Exchange Management Act. So similarly, purchase of movable assets from outside India. So again, let's assume a scenario where a company has imported machine and that machine is forming part of fixed asset. But however, from the perspective of applicability of provisions of Foreign Exchange Management Act, any import of goods will form part of the current account transaction. So even though a purchase of a machine is otherwise altering the asset side, fixed asset side of a person resident in India, because the movable goods are treated, import of movable goods are treated as current account transactions, the provision with respect to such imports will be governed by Foreign Exchange Management Current Account Transaction Rules 2000. Similarly, in the intangible assets, capital work in process, intangible assets under development, even though it involves foreign currency payment, all such movable things will come under Foreign Exchange Management Current Account Transaction Rules 2000. Then non-current investment outside India. So where the company has made non-current investment in a joint venture or a wholly owned subsidiary outside India. So such investment will alter the assets side of the person listed in India, and such transactions are treated as capital account transactions, and provisions with respect to such transactions are governed by Foreign Exchange Management Transfer or Issue of any Foreign Security Regulations 2004. Similarly, long-term loans and advances to person resident outside India. So where an Indian entity has given loan to person resident outside India, that because then giving loan to a person will alter your asset position, because and that transaction is entered with person resident outside India, that transaction will be treated as a capital account transaction, and provisions with respect to that transaction will get covered under Foreign Exchange Management Borrowing and Lending Regulations 2018. And with respect to the current assets, the inventories and trade receivables, because as we discussed, that import of any type of goods will per se is treated as a current account transactions. Similarly, on export of goods, if there are any trade receivables, even though they are ultimately forming part of the balance sheet and altering the asset side of the balance sheet, such current assets are not treated as a capital account transactions, but are treated as a current account transactions. So coming back to the definition of capital account transaction, means a transaction which alters the assets or liabilities, including contingent liabilities. So if a person resident in India has given a guarantee to person resident outside India, so giving such guarantee will create a contingent liability for such person. And in connection with that, issuing guarantee, as the definition suggests, that if it is means a transaction which alters the assets or liabilities, including contingent liabilities. So as a giving guarantee creates a contingent liability, such guarantee will be treated as a capital account transaction unless it is given in the ordinary course of business for carrying out any import or export of goods transaction. So as the definition suggests, capital account transaction primarily alters your balance sheet position, asset or liability position, and also it's an inclusive that the definition says it includes all such transactions which are per se treated as a capital account transactions, and for which the Reserve Bank of India has come out with the regulations under Section 6, subsection 2, and the central government has come out with the rules under Section 6, subsection 2A. All such transactions will be treated as capital account transactions. So why it is important to analyze a particular transaction as capital account or current account? Because you will see that for the current account transactions, there are only 3 schedules are given, and if a transaction is not covered under those 3 schedules, then we can conclude that that particular current account transaction is permitted to be carried out. However, if by mistake we classify a particular transaction as a current account transaction instead of a capital account transaction, then we might not refer specific provisions or specific regulations or rules issued by Reserve Bank of India or central government with respect to that particular transaction, and might end up in non-complying with the particular transaction under FEMA, and which may attract penalty. So analyzing a transaction properly under FEMA is very, very important. Therefore, it is important to understand what constitutes capital account transaction and what constitutes current account transaction. So certain examples which already discussed when we refer to the balance sheet side, those are of capital account transactions are issue of shares to person listed outside India. So there are specific non-debt instrument rules 2019, which we need to comply when the shares are issued to person listed outside India. Then availing loan from person listed outside India, giving guarantee to person listed outside India, which are corporate guarantee, personal guarantee, or performance guarantees. Purchase of immovable property outside India by person listed in India, investment in securities outside India by person listed in India, providing loan to person listed outside India by person listed in India. So these are the few examples of capital account transactions. So what we are trying to analyze is, if a particular transaction is a capital account transaction, then we need to refer to the specific regulations or specific rules with respect to that capital account transactions, and then conclude whether that transaction is permitted to be carried out or whether that permission is not permitted to be carried out. And if it is permitted, what type of compliances are required to be done. And accordingly, you can conclude on the compliances on the reporting part and make sure that that particular transaction is very well within the provisions of Foreign Exchange Management Act. So the current account transactions, the FEMA Section 2J defines current account transaction means a transaction other than a capital account transaction, and without prejudice to the generality of the foregoing. Such transaction includes payments due in connection with foreign trade, other current business services, and short-term banking and credit facilities in the ordinary course of business, payments due as interest on loans and as net income from investments, remittance for living expenses of parents, spouse, and children residing abroad, and expenses in connection with foreign travel, education, and medical care of parents, spouse, and children. So the definition suggests that means of transactions other than a capital account transaction. So while analyzing the provisions of or analyzing these definitions or a particular transaction, we have to first make sure that that particular transaction is not a capital account transaction. And if it is a capital account transaction, then we have to refer to the specific regulation or specific rule to understand the compliance under FEMA or applicability of provisions under FEMA. If that is not a capital account transactions, and then it will be treated as a current account transactions, and without prejudice to the generality of the following, such transaction includes. So there is an example given. So all the payments due in connection with foreign trade, that means the payments due on import of goods or payments due on import of services or other current businesses, services, and short-term banking and credit facilities in the ordinary course of business. So for example, if an importer has obtained a letter of credit for import of goods and which will be settled within 6 months from the date of import. So even though there is a letter of credit or there is a credit facility obtained from the banker, which creates a foreign currency liability, such credit facility, because it is in the ordinary course of business, will be treated as a current account transactions. Similarly, any payment of dues as interest on loans or as net income from investments like dividends, then remittance for living expenses of parents, spouse, and children residing abroad, and expenses in connection with foreign travel, education, and medical care of parents and spouse and children, all these transactions will be treated as current account transactions. So whenever we need to analyze a particular cross-border transactions or a foreign exchange transaction, as I said, first we need to see whether it's a capital account transaction, whether it is altering the asset side or liability side of a person resident in India, or if it is a person resident outside India, for example, a non-resident Indian, if he purchases any property in India, so technically it is altering his asset side of the balance sheet and creating an asset of a person resident outside India, the asset which is situated in India. So such transactions will be treated as capital account transactions. In addition to such transaction, if a specific transaction is given under section 6 subsection 2 as by Reserve Bank of India by way of issuing regulations, or section 6(2)(a) by issuing rules by the central government, all such transactions will be treated as capital account transaction. And if a particular transaction is not covered under capital account transaction, then it will be a current account transactions. And in addition to that, if there is any payment due in connection with foreign trade or other current business services and short-term banking and credit facilities in the ordinary course of business, and examples given in this definition, such transaction will be treated as a current account transactions. So these are few examples of current account transactions, like payment due in connection with foreign trade. On import of goods, we need to pay to the supplier of the goods outside India. Import of services, similarly, we need to pay the supplier of services outside India, where so there's an outflow of foreign exchange. Then obtaining a letter of credit in connection with such imports. So since this letter of credit is taken from the banks in the ordinary course of business, such obtaining letter of credit, it will be treated as a current account transactions. Similarly, payment due as interest on loans and as net income from investments. So if suppose shares are issued to a resident outside India, NRI, and the dividend is declared, then such amount is repatriable to such person, a non-resident Indian. And because it involves foreign exchange, such remittance will be treated as, and it is net income from the investments or earning from the investment made in India, such remittance will be treated as a current account transaction. Similarly, if there is any loan taken from a non-resident Indian and any interest is to be paid, then payment of such interest will be treated as a current account transaction. So while borrowing from a person resident outside India, borrowing per se creates a liability and alters the liability side of a person resident in India, such borrowings will be treated as a capital account transactions. The payment of interest on such borrowing will be treated as current account transactions. And similarly, under current account transaction rules, there are a list of remittances which are permissible, which are specifically treated as current account transactions. So, as far as the applicability of provisions of FEMA is concerned, one must ensure that while analyzing a particular transactions, it has to be categorized properly as a capital account and current account. And if it is a capital account transaction, then we must understand which type of transaction it is and exactly which regulation or which rule is applicable. Because as I said, the underlying principle under capital account transaction is that unless something is specifically permitted, it is restricted and you require prior permission of Reserve Bank of India. But with respect to current account transactions, because the provisions with respect to current account transactions are given under current account rules, and there are only 3 schedules which are given. Schedule 1, the transactions which are prohibited under Foreign Exchange Management Act. Schedule 2, transactions which require prior approval of the central government. And Schedule 3, transactions which require prior approval of the Reserve Bank of India. So basically, with respect to current account transaction, if a particular transaction is a current account transaction, and if that transaction is not covered anywhere in Schedule 1, Schedule 2, and Schedule 3, then we can very well conclude that that transaction can be carried out by the person without any approval of Reserve Bank of India or central government. But with respect to capital account transaction, if that particular transaction is a capital account transaction, and if a regulation is silent on such transaction, then we have to conclude that that particular transaction is not permitted, and prior approval of Reserve Bank of India or central government, as the case may be, will be required to carry out that particular transaction. That's why it is very important to understand and analyze a transaction either as a capital account or current account properly, and then apply the provisions which are applicable to such transactions. Further, under FEMA, the important definitions of drawal, what amounts constitute drawal of foreign exchange, is also defined. It says drawal means drawal of foreign exchange from an authorized person and includes opening of letter of credit or use of international credit card or international debit card or ATM card or any other thing by whatever name called, which has the effect of creating foreign exchange liability. So the definition of drawal is very vast. It is not always that you approach bank and withdraw money and apply for a foreign exchange that will constitute the drawal. Drawal means drawal of foreign exchange by any of these means. So from an authorized person. So we saw who is authorized person. So authorized dealers, category 1 authorized dealers, then full-fledged money changers, restricted money changers who are allowed to carry out transactions under foreign exchange. So they are allowed to. So authorized dealer category 1 are allowed to carry out all types of capital and current account transactions. Full-fledged money changers are allowed to purchase and sell foreign exchange for the purpose of private and business visits abroad. And restricted money changers are permitted to sell foreign exchange for private or business visits abroad. So here, this drawal says that if means a drawal of foreign exchange from an authorized person. So if you approach any such authorized person and draw foreign exchange, that will constitute drawal and includes opening of letter of credit or use of international credit cards. So if someone is visiting outside India and using an international credit card, such usage of international credit card will also be treated as a drawal of foreign exchange. And while doing so, we have to make sure that the person who is using for the purpose for which is being used is in compliance with Foreign Exchange Management Act, and such transaction is permitted to be carried out. Even such drawal, while sitting in India, if you log into the website and place any order on the website for import of goods from outside India, such usage of international credit cards or international debit cards will also constitute drawal under Foreign Exchange Management Act. If a person has gone abroad and has used ATM card and withdrawn foreign exchange from the ATM card, and where the debit is happening to his account in India, which is maintained in rupee with the bank in India, such withdrawal of foreign exchange will also be treated as a drawal, or any other thing by whatever name called, which has the effect of creating foreign exchange liability, will be treated as a drawal. So if you are giving any sort of a guarantee, or if you are giving any sort of letter of comfort, which is creating a foreign exchange liability, such transaction will be treated as a drawal. And so whenever a person resident in India is drawing a foreign exchange, he has to make sure that that particular transaction is permitted under Foreign Exchange Management Act. So while concluding whether that transaction is permitted or not, again, we have to basically classify that transaction as a capital account transaction or a current account transaction. And if that transaction is capital account transaction, then we have to refer to the specific regulation. For example, if a person has gone abroad, let's say he has gone to Singapore, and there he is using his international credit card for incorporating a company and paying the subscription money or the initial capital to incorporate that company. So as we discussed, as the definition suggests, such use of credit card will be treated as a drawal under FEMA. And now that person is using that credit card for opening a company outside India. And we saw that opening of company outside India is treated as a capital account transaction. So any investment outside India or setting up companies outside India will be treated as a capital account transaction. In that case, we need to refer to the specific regulation and find out whether such use of drawal mechanism is permitted under that regulation or not. And where ODI regulation says that any setup of company outside India can be done only through normal banking channel by remitting money from India through an category 1 authorized dealer. So that means that person who is otherwise can use that international credit card, such usage or such drawal of money by using the international credit card, which the drawal is used to pay the share application money outside India will be a violation of the provisions of Foreign Exchange Management Act. So whenever a person resident in India is drawing a foreign exchange by any of these means, he needs to first analyze whether that transaction is a capital account transaction or a current account transaction. If that transaction is current account transaction, then he has to see whether that transaction falls under Rule 3, Rule 4, or Rule 5 or of Current Account Transactions Rules 2000. So as we discussed, with respect to current account transactions, these are the only three rules which which make provision with respect to any current account transaction. So Rule 3 suggests the transactions which are prohibited and no drawable is permitted, no drawable of foreign exchange is permitted for such transaction. So for example, buying a lottery ticket. So a person resident in India cannot log in to the website of a foreign company and use his international debit card, credit card, or draw foreign exchange from authorized person to buy foreign exchange for the purpose of buying lottery ticket from a entity outside India. So such transactions which are given under Rule 3 are the prohibited transaction under current account transaction rules. Then there are Rule 4, which suggests list of transactions which require prior approval of Government of India. And there are transactions under Rule 5, which give a list of transactions which require prior approval of Reserve Bank of India. So whenever a person has to draw foreign exchange, he has to first conclude whether that transaction is current account or capital account. If it is a current account, then he needs to ascertain whether such current account transaction is prohibited. If it is prohibited, he cannot carry out. If the transaction requires prior approval of central government, then he has to approach the respective ministry, get approval, and then only carry out the drawal of the foreign exchange. And if the transaction is given under Rule 5, mentioned in the Rule 5, then that transaction will require prior approval of Reserve Bank of India. Then he has to approach Reserve Bank of India, and after getting approval from RBI, then only he can use, he can draw money for the purpose of that transaction. Otherwise, as I was saying, that with respect to current account transaction, the underlying principle is that if a particular transaction is not covered in Rule 3, Rule 4, or Rule 5, then we can conclude that such transaction is permitted without any limit. For example, if a person wants to import or a company in India wants to import CNC machine worth rupees, say 50 crore. Now, we need to analyze this transaction and consult whether this transaction is a capital account transaction or a current account transaction. So the transaction is that an entity in India is importing a CNC machine worth rupees 50 crore. So we saw that the import of goods and services is treated as a current account transactions. So here the first conclusion is that the import of machine is a current account transaction. So then we don't have to refer to any of the regulations and rules with respect to capital account transaction. So then we will refer to Rule 3 and find out whether import of such machine is included in this prohibited list. The answer is no. There is no such prohibition on import of CNC machines. Then we'll go to Rule 4 and analyze and find out whether such import of goods is covered, requires any prior approval. So on closer look of the items which are covered under Rule 4, we'll conclude that such import of CNC machine is neither mentioned in prior approval list of under Rule 4. Similarly, under Rule 5 also, you will not find such mention. So we can very well conclude that the import of CNC machine worth rupees 50 crore is a current account transaction, and it is neither prohibited nor it requires prior approval of Government of India or Reserve Bank of India. And therefore, such transaction can be freely carried out by approaching the authorized dealer. So the FEMA, the provision says that whenever you have to carry out any foreign exchange transactions, that can be carried out by drawing the foreign exchange by either approaching authorized person, or it can be done by using the international credit cards or international debit cards, or by also using ATM cards wherever it is permitted. So for, let's say, for small remittances or small purchases, use of international credit cards will be also permitted, or debit card will also be permitted. So while analyzing a transaction, we need to conclude, and once we understand that a particular transaction is a current account transactions and it is not covered in Rule 3, Rule 4, or Rule 5, then we can very well conclude that it can be done without any restrictions, and the entity can approach authorized person to carry out such transaction. These are few examples of current account transactions: payment of interest on foreign currency loan, payment of dividend to non-resident shareholders where investment is on repatriation basis, payment of dividend to non-resident shareholders where investment is on non-repatriation basis, payment of rent to non-resident Indian, import of machinery. So these are the different examples of current account transactions where you will find that such transactions, there is no restrictions under Rule 3, Rule 4, or Rule 5, and such transaction can be carried out. One important, so it may happen that a particular transaction may involve capital account transaction or a current account transaction. For example, import of machinery on deferred credit terms. So where in this example, XYZ Private Limited has entered into a contract with ABC Corporation USA for supply of a CNC machine worth $1 million. And as per the terms of supply, XYZ is required to pay the consideration as under: advance USD to $250,000, within 30 days of shipment USD $250,000, and balance USD 500,000 on completion of 30 months from the date of shipment. So here, as I said, any transaction, we have to analyze it properly. So in this case, there are two transactions from the FEMA perspective. One is there is an import of machinery. So as we saw, import of machinery gets covered into import of goods, and that is treated as current account transactions. And the second portion of the contracts that suggests that the payment is to be done on a deferred credit terms. So here, the deferred credit term, then we also discussed that any payment to be made or any liability created, which is a current liability, which is to be settled within 6 months from the date of shipment, that is treated as a normal current account transaction. But if there is any deferred credit arrangement where the repayment is beyond 6 months, then that will be treated as a deferred credit arrangement, and it will become a capital account transaction. So in this import of machinery on deferred credit terms, there are two, on analyzing this, there are two types of transactions involved. The first, import leg, is treated as a current account, but the deferred credit is treated as a trade credit, and which gets covered under Borrowing and Lending Regulations 2018. And we need to see whether such type of deferred credit arrangement is permitted. So this payment of balance USD 500,000 on completion of 30 months, so that means almost 2.5 years from the date of shipment. So such deferred arrangement will be treated as a capital account transaction. So whenever we are analyzing a transaction, it may happen that a current account transaction may involve certain capital account compliances, and then in that case, we need to make sure that such deferred credit arrangement is permissible. So for example, in this case, the entity is importing a machine, and there's a deferred credit arrangement which is required to be settled within 30 months. And if you look at borrowing or lending regulations, where deferred trade credit arrangement up to 3 years for capital goods is permitted. So up to 36 months from the date of shipment is permitted. Here it is up to 30 months, the amount will be settled. So even though there is a deferred credit arrangement, and that deferred credit arrangement is a capital account transaction, so that here the deferred credit arrangement of 30 months is within the limits permissible under such regulations. So a transaction may cover both the aspects. Some portion will be current account, some portion will be capital account. In that case, we need to bifurcate, dissect that transaction in such a way and find out it complies with current account also and capital account also. And if the answer is that if it is not complying with any either current account or capital account, then we need to approach Reserve Bank of India for the prior approval. And if that item is covered under Schedule 4, then we need to approach central government for specific approval. So similarly, person, there's an important definition which one needs to understand, that is person resident in India and person resident outside India. Because whenever a person, we are dealing with a person either resident in India or resident outside India, we need to see whether provisions of FEMA are applicable to such transactions or not. So while, for example, if a company is issuing shares to a person, unless you know that whether that person is a person resident in India or person resident outside India, will not be able to conclude whether the company requires or whether the provisions with respect to FEMA, under FEMA, are applicable to issue of shares to that person or not. So the FEMA defines defines the concept person resident in India. So we'll analyze that in next 5-10 minutes. A person resident in India means a person residing in India for more than 182 days during the course of the preceding financial year, but does not include a person who has gone out of India or who stays outside India, in either case for or on taking up employment outside India, or for carrying on outside India a business or vocation outside India, or for any other purpose in such circumstances as would indicate his intention to stay outside India for an uncertain period. So here what it says that if a person has resided in India for more than 182 days in a preceding financial year, will be treated as a person resident in India, but does not include if he has gone outside India for the purpose of employment or taking up any business or vocation or for unspecified period. So we have to see, with this example, how it can be analyzed. Mr. Sharad Verma, an Indian citizen, was working with Microsoft India Private Limited since April 2014. He left India to join the employment of Microsoft Corporation USA on 10th of August 2019, and he was accompanied by his wife and daughter. Till then, he was residing in India. So what will be the residential status of Mr. Verma and his dependent on 9th of August 2019, 1st of January 2020, and 18th of October 2020. So these are the 3 dates, and we have to apply the definition of person resident in India. So what it says on 9th of August, so he was working with Microsoft India Private Limited. Then he joined the employment of Microsoft USA and moved to USA on 10th of August. And so basically, since he was staying in India and he's an Indian citizen, up to 9th of August 2019, he is a person resident in India. But the moment he goes abroad for the purpose of employment, his status will undergo a change and he will immediately become a non-resident Indian, and his status will go under change, will change. So here basically what it says that a person resident in India means who has stayed in India for more than 182 days, but does not include. So this 182 days criteria will not be applicable to such persons who have gone outside India for the purpose of employment, business, vocation, or for unspecified period. So as we discussed on 9th of August, he will become he is person resident in India, but from 10th of August onwards, he becomes person resident outside India and he will be non-resident Indian. So obviously on 1st of January 2020, he is a non-resident Indian, and 8th of October 2020, he remains a non-resident Indian. And what will be the residential status of his wife and daughter on the above mentioned days? So again, because the wife and daughter have accompanied him and they have gone outside India for unspecified period, so their status will also undergo a change, and like Mr. Verma, and they will also become non-resident Indian immediately moving out of India from 10th of August 2019 onwards. So 182 days criteria is applicable to the persons who are residing in India. But if a person has gone outside India for taking up employment, business, vocation, or for unspecified period, then in that case, they will immediately become non-resident or person resident outside India. So similarly, here, in the second example, Mr. Sharad Verma left India on 1st of July 2019 on a tourist visa. He was planning to have a world tour for a period of 1 year and come back to India on 30th June 2020. What will be his residential status as on 2nd July 2019, 1st of April 2020, and 2nd July 2020? So under FEMA, now the intention of going abroad also matters. So here, basically, because he has gone outside India on a tourist visa, he remains a person resident in India. So even though he has moved out of India, he will continue to remain a person resident in India because he has gone outside India on a tourist visa for a specified period. Similarly, with respect to students going abroad for studies for specified duration, because if you look at the definition, students who are going abroad, they are not covered under any of this excluded category, and they were facing a lot of problem with respect to, because they were required to obtain foreign loan from the foreign banks for their education and all that, and spend money. So with respect to that, even though they have gone outside India for the purpose of education, and it is not specifically covered under the employment, business, vocation, or unspecified period, because they are going there for a specified period for up to the duration of the course, RBI has come out with a circular where it has clarified that all such students who are going abroad for the purpose of for studies, those will be treated as non-resident Indians. So here, the moment they go abroad, they will be treated as non-resident Indians, and they will be permitted to carry out such activities like take education loan outside India to complete their educational courses. So to give them that flexibility, this carve-out has been made. So otherwise, a person who has gone outside India or for the purpose of employment, vocation, or business, or for any unspecified period, will be treated as a person resident outside India. And a person otherwise who is in India and who has completed 182 days in the preceding financial year will be treated as person resident in India. So basically, the definition of person resident in India has got two parts. One part A talks about person who was residing in India for more than 182 days in the preceding financial year, but who has gone outside India for the purpose of employment, business, or vocation. Similarly, part B talks about the persons who have come to India or come to or stay in India in either case, otherwise than for on taking up employment in India, or for carrying on in India a business or a vocation, or for any other purpose in such circumstances as would indicate his intention to stay in India for an uncertain period. So like we saw that the person who has gone abroad for the purpose of employment will immediately become a non-resident Indian. Similarly, a person who has come to India for the purpose of employment, such person, even though he is a foreign citizen, will be treated as a person resident in India if he has come to India for the purpose of employment or for the purpose of business, vocation, or for any other purposes, which in circumstances which as would indicate his intention to stay in India for an unspecified period. So while determining the status of a person, whether he's a person resident in India or not, we need to see for how many days he has stayed in the preceding financial year, then for what purposes he has come to India, and if that purpose is for the purpose of employment, business, or vocation, or for unspecified period, that person will be treated as person resident in India. Similarly, as per the definition of person resident in India, the branch offices, liaison offices, and project offices of the foreign entity are treated as person resident outside India. So even though those are not separate legal entities and extended arms of the foreign companies or foreign entities, because those are set up with a specific approval of Reserve Bank of India, the such branch offices, liaison offices, and project offices of person resident outside India set up in India will be treated as person resident in India. And similarly, all such branch offices, trading offices, or liaison offices established outside India by a person resident in India will be treated as, again, person resident in India. And because they can carry out only such specific activity which are specifically permitted by Reserve Bank of India. So all the offices, either trading office or non-trading office, which are being set up by person resident in India, which are set up outside India by person resident in India, will be treated as person resident in India. So just to conclude, as far as the definition of person resident in India is concerned, a person who has gone out of India for the purpose of employment, vacation, or business, or for unspecified period, will immediately become non-resident Indian or person resident outside India the moment he goes outside India for such purposes. And the person who has come to India for the purpose of employment, business, vocation, or unspecified period will become a person resident in India on completion of 182 days in the preceding financial year. And he'll be treated, even though he's a US citizen, he'll be treated as a person resident in India. And one more important category of person under FEMA which is given is person resident but not ordinary resident. So we know what is person resident in India, and second is person. So the person who is not a person resident in India is treated as person resident outside India. And there is a third category which is person resident but not ordinary resident. So that means in the same example here, Mr. John Smith, a US citizen, was employed with GE Corporation USA. He joined GE India Private Limited as Chief Executive Officer. So he has come to India on secondment from GE Corporation USA. And now, as far as the definition is concerned, once so he becomes person resident in India, but there is a carve out and specific provisions have been made for such persons, and they are treated as person resident but not ordinary resident. And for them, a different provisions with respect to the remittance outside India is given under current account transaction rules. So what it says that a person who is a resident but not permanently resident in India and is a citizen of foreign state other than Pakistan, or is a citizen of India who is on deputation to the office or branch office of a foreign company or subsidiary or joint venture in India of such foreign company, for them, for such category of persons, the limits of LRS is not applicable. So whatever salary they earn in India, they are allowed to take that salary. So even though they are person resident in India, they are allowed to make remittance of such salary post payment of taxes. And so entire salary which they have earned in India, they post payment of taxes, they are allowed to take outside India. And that 250,000 limit is not applicable to such persons. So if such foreign citizens who have come to India and those are treated as person resident but not only resident, they are allowed to repatriate outside India the entire salary post payment of taxes. And specific with respect to that, the provisions are given under Regulation 5F8 of the Foreign Currency Account Regulations, which permit them to remit money, entire money post payment of taxes outside India, or they are also allowed to receive directly remuneration from their parent company to their foreign currency account outside India. So such category of person who are person resident but not ordinary resident have been given that flexibility by this Regulation 5F8 of the Foreign Currency Accounts Regulations. So under residential status under FEMA, the person will be categorized as either person resident in India, and as per the definition provided in Foreign Exchange Management Act, and all the persons who are not person resident in India will be treated as person resident outside India, as per the definition provided in Foreign Exchange Management Act. Then, as we discussed, there is a third category, the person resident but not ordinary resident, as we discussed, that is given under current account rules, read with the Regulation 5.8 of the Foreign Currency Account Regulations. Then, for the different regulations, the status, the residential status, or the category of persons have been defined as non-resident Indians, that is defined under respective regulations. Overseas citizens of India, so who have surrendered Indian citizenship and who are now foreign citizens but hold OCI card, those are treated as those are defined under respective regulations that or rules. For example, non-debt rules, instrument rules, or immoral property regulations, or deposit regulations. So all these definitions have been given in the respective regulations. And overseas corporate bodies, so which are, there is a specific regulations which have foreign exchange management, withdrawal of general permissions to overseas corporate bodies, OCB regulation 2003. So these are the different residential status which have been defined under FEMA and or defined under regulation, either act or under regulations or rules. So while applying the provisions with respect to a particular transaction, for example, purchase of immoral property in India, we have to basically refer to the respective regulation and find out what is the definition of NRI given under that regulation, and then whether that person is categorized as NRI as per the definition given under that regulation. We cannot use definition given under different regulation because each regulation defines that particular terminology from a different perspective. So we have to again find out the specific definition given under that regulation and see whether that particular person is eligible to carry out that transactions or not. So now, after understanding the definitions, different important definitions under Foreign Exchange Management Act, we will now go through the important provisions with respect to liberalized remittance scheme and understand what exactly this scheme is, what are the do's and don'ts, and then we'll also go through 13 odd case studies and analyze the provisions of LRS to those case studies. So basically, liberalized remittance scheme is available to facilitate all the resident individuals who are residing in India to remit funds abroad for permitted current or capital account transactions. So where both the limits have been subsumed. So all put together, there's a limit of $250,000 per financial year, within which a person who is resident in India is permitted to carry out any permitted current account or capital account transactions. So even though the LRS scheme looks very simple, but when you apply that particular scheme to a particular transaction, one is required to have a perfect or complete knowledge of current account transaction rules, then all the capital account transaction rules, and then find out that whether that particular resident individual is permitted to carry out that particular transaction. So first, analyze that transaction, whether it's a current account or capital account. If it is a capital account, then find out which specific regulations are applicable, and then see whether that resident individual is permitted to carry out that transaction or not. So, so this requires actually, and LRS requires understanding of the entire Foreign Exchange Management Act in its entirety, and see which regulations a resident individual is permitted to carry out such foreign currency transactions. For example, here it says that a resident individual can remit up to $250,000 for any permitted current account or capital account transactions. So now let's assume that a resident individual proposes to give a foreign currency loan to his close relative abroad. So he wants to remit money to his close relative abroad for the purpose of under LRS. So now what we'll do to analyze this transaction, the transaction is that the resident individual is remitting money abroad, and that money is being remitted as a loan to his close relative. So we will refer that to borrowing and lending regulations. And there is a regulation which talks about lending by person resident in India. And we will see that there is no such mention that whether resident individual is permitted to do or not. So as I said, underlying principle under capital account transaction is that if a particular transaction is not specifically permitted, that means it is restricted. So in that case, because there is no specific permission given to a resident individual to give foreign currency loan to person resident outside India, such transaction, even though that transaction is within the limits of $250,000, will require prior approval of Reserve Bank of India. So LRS is basically, this is a facility given to resident individuals. So earlier, under current account transaction rules, for different remittances, different limits were given. For example, for private visit, the limit was $10,000. Likewise, for medical expenses, for education, so different limits were prescribed. But under this, now, under $250,000 LRS scheme, all these limits have been subsumed, and it is up to a person to decide for which purpose, permitted current account or capital account purpose, he wants to utilize that entire limit of $250,000 per financial year. So this scheme is available only to the resident individuals for permitted current account or capital account transactions, and the limit is subsumed for both the transactions. So no separate limits have been prescribed. And the present limit under LRS is $250,000 per financial year. And this is not available to corporates, partnership firms, HOFs, and trusts. So if there is any remittance which has to be done by a corporate, for example, you will find the case of a donation. So whether a person can donate under LRS, the answer is yes, if he is a resident individual. But if he's a corporate, then he has to stick to the limits prescribed under Schedule 3 of Current Account Transaction Rule, which provides limits on how much a corporate can remit money outside India for the purpose of donation. So if that limit is beyond the limits given under Schedule 3 of Current Account Transaction Rules, then such corporates or such entity will have to approach Reserve Bank of India and seek prior approval before remittance. So LRS is per se available to only resident individuals. Then for permitted current account and capital account transaction, and within an overall limit of $250,000 per financial year. Under this scheme, what it says that if you want to remit any money beyond the limit prescribed under $250,000 under LRS, then prior permission of Reserve Bank of India is required. Under this scheme, an individual is also permitted to open, maintain, and hold foreign currency accounts with a bank outside India for making remittances. Otherwise, under FEMA, if a person resident in India wants to open a foreign currency account outside India, it requires prior approval of Reserve Bank of India. So let's assume there is an exporter is having sole proprietary firm in India, and to facilitate receipt of export proceeds, he wants to open a foreign currency account outside India. Such opening of foreign currency account will require prior approval of Reserve Bank of India. However, if that individual in his individual capacity and not as a sole proprietor of this business wants to open an account under LRS and remit money from India to that foreign currency account outside India, which is opened under LRS scheme, such opening of account, maintaining account, and holding foreign currency accounts outside India is permitted. And such foreign currency accounts may be used for putting through all transactions connected with or arising from remittance eligible under the scheme. So here, like that account can be used as a special purpose account where it will be opened under LRS scheme. The money will be remitted every financial year from that to that account. And then that person who is residing in India can decide for what purposes that money can be used. Only thing is what he is to ensure that the purposes for which that money is used should be a permitted capital account or current account transaction. So over the periods, the scheme was introduced from February 4, 2004, and the Reserve Bank of India, depending on the foreign currency reserve position, has kept on changing the limits under this LRS scheme. So initially it was 25,000, then in 2 years it was made 50,000, then it was increased to 1 lakh, 2 lakh, and then again in 2013 there was issue with the foreign currency reserve position. So Reserve Bank of India reduced that limit to 75,000, and then thereafter increased it to 125. And presently from May 26, 2015, the limit has not been touched, and it is now $250,000. So any resident individual is permitted to remit under LRS for any permitted capital account and current account up to $250,000 per financial year. So only thing is, for what purposes it cannot be used. So as we saw in the scheme, it says permitted capital account or current account. So obviously, if it is a current account transaction, and if the transaction is covered under Schedule 1 of current account rules, which provides a list of transaction which is prohibited, certainly this the LRS money cannot be used for such transaction. Similarly, it cannot be used for margins or payment of margin calls to overseas exchanges or overseas counterparty. It cannot be used for remittances for purchases of foreign currency convertible bonds issued by Indian companies in the overseas secondary market. Because obviously the underlying asset for this is shares of Indian company. So it is like a FDI, ODI issue where you are actually remitting foreign currency outside India, buying foreign currency convertible bonds, and which have an underlying asset as shares of an Indian company. So such remittances for purchase of FCCBs is not allowed. Then remittance of trading in foreign exchange, so that is not permitted. Capital account remittances directly or indirectly to countries identified by the FATF Financial Action Task Force as non-cooperative countries and territories from time to time. So any capital account transaction, so for example, under LRS scheme, an resident individual can set up a company abroad by using this LRS limit of $250,000. So in addition to LRS compliance, the person, resident individual, is also required to comply with ODI regulations, Regulation 22, and file form ODI and all that. So however, in this case, even though a setting up of company is abroad, by a person, a resident individual is permitted under ODI regulations now from August 3, 2013, and it is also, because it's a permitted capital account transaction, it can be, LRS limit can be used by an individual. One rider is there while setting up such company, that resident individual has to make sure that that country is not identified by FATF as a non-cooperative country and terrorist territories. So that precaution has to be taken. Further, while remitting money directly or indirectly to those individuals and entities identified as posing significant risk of committing acts of terrorism, as advised separately by the Reserve Bank of India from time to time, this money cannot, LRS limit cannot be used for these purposes. So these are the prohibited remittances under LRS. Otherwise, for all permitted capital account and current account transactions, this LRS limit is applicable, and a resident individual can certainly utilize this limit and carry out this capital account or current account transaction. So I have given this list of such permissible capital account and current account transactions. So we'll not repeat those. Only with respect to, as we discussed, that both the limits are subsumed now. So all put together, an individual is having $250,000 in a financial year for under LRS. But there are certain expenses or certain remittances for which additional the remittances in addition to $250,000 will also be allowed for without approaching Reserve Bank of India based on certain documentations or certain evidences. For example, studies abroad. If a student is going abroad, and if the cost of that education is more than the limits prescribed under LRS, that is $250,000. So then that student can approach authorized dealer with for additional remittance by providing the estimate from the foreign university about the expenditure for that studies. And with those particular documents, the authorized dealer will permit him to remit additional money outside India, which will be over and above this LRS limit of $250,000. Similarly, for medical treatment outside India, if that expenditure is going to be more than $250,000, then for such additional remittances based on the estimate from an overseas hospital, the banks in India will permit such additional remittance in addition to $250,000. Then if a person is emigrating for good outside India, then remittance will be allowed only to meet incidental expenses in the country of immigration, and if there are going to be additional expenditure for that. However, if the remittance is to be done to fulfill certain credit criteria, then or earning the credit points, then such additional remittance will not be allowed. So for immigration, only remittance, additional remittance will be allowed only to meet the incidental expenses required to meet in the country of immigration. But for all other purposes like maintenance of close relative, so basically the limits are subsumed limit of $250,000 will be applicable. So when a person or resident individual decides to utilize remit money under LRS, he has to designate a branch of an authorized dealer through which all the remittances under the scheme will be made. So in order to monitor that the $250,000 limit is not breached, the resident individual is required to carry out that LRS transaction through designated branch of an authorized dealer and put all LRS transaction through the same AD. Then while making a remittance, it is mandatory for a resident individual to provide PAN to make remittance under the scheme. And because now if the remittance amount is above the threshold, there is a requirement of payment of TDS also. While making the remittance, the resident individual is required to furnish form A2 along with the documentary evidences and the purposes for which the money is being remitted. And as we discussed, this LRS money can be retained, reinvested, and the income earned on the investment can be again brought back in the same account outside India and need not be brought back to India as and when it is earned. So you can just keep on parking money outside India, and any interest earned on that investment or foreign currency account opened outside India can be kept outside India and reinvested in eligible current account and capital account transactions. So this was the salient feature with respect to LRS. Now we'll analyze with different case studies the provisions of LRS. So case study 1, Mayuri Joshi proposes to purchase a residential property for USD 225,000 in UAE. As per the terms of purchase, she needs to remit USD 75,000 upfront and balance in 4 equal installments during the financial year 2022-23. Mayuri Joshi has her own funds to the tune of $75,000. For the balance amount, she has approached a non-banking finance company to avail personal loan equivalent personal loan for purchase of this property. So whether the above transaction is permissible under LRS. So one more important provisions under LRS is that although RBI has permitted $250,000 limit for each individual for carrying out any current capital account transactions, the resident individual is supposed to use only his own funds and not borrowed funds. So while remitting money to carry out any capital account transaction, the person is required to give declaration to the authorized dealer that the money which is remitting is not his own funds and is not borrowed funds. So that borrowing cannot be even from the relatives, or that borrowing cannot be from any banks or financial institutions. So in this case, because Mayuri Joshi, she is proposing to take loan from NBFC in India to fulfill her obligation, this transaction is not in compliance with provisions of Foreign Exchange Management Act, and she will not be permitted to take foreign currency loan, to take any loan, rupee loan also, from the banks in India or NBFCs or financial institutions in India or from relative in India. Case study 2, Mayuri Joshi proposes to purchase a residential property for USD $225,000 in UAE. As per the terms of purchase, she needs to remit USD 75,000 upfront and balance in 4 equal installments during the financial year 22-23. So the case is same. However, in this case, Mayuri has her own funds to the tune of $75,000. For the balance amount, she has approached HSBC Dubai to avail loan equivalent facility. So here, instead of approaching a local bank, now she has approached a bank in Dubai. The loan carries 4% rate of interest, and the entire loan will be served out of the rental income earned from the aforesaid property. So what this case is suggesting that she is going to remit only 75,000 from India, and rest of the money is going to be funded by a bank in Dubai. And she's also, once she acquires the property, takes possession of the property, she is going to give that property on rent. She will earn rent from the property, and that loan will be served from that rent only. So there is no further outflow of money is involved in this case. So whether such transaction is permitted, because as far as the remittance is concerned, the remittance is limited only to the extent of $75,000. Now, from FEMA point of view, as we discussed, we need to analyze this transaction, and first and foremost, we need to see whether this transaction is in compliance with provisions of FEMA and it is a permitted capital account or current account transaction. So now here, Mayuri Joshi is going to purchase a residential property in Dubai. So it is from the definition of capital account transaction, she is creating an asset outside India. So the person resident in India is creating an asset, foreign currency asset, which is located outside India in the form of an immovable property. So this is a capital account transaction. So once we know that this is a capital account transaction, we have to refer to basically a specific regulation, that is foreign exchange management, buying of immovable property by person resident in India, buying immovable property outside India by person resident in India. So there you'll find that, okay, the resident individual or person resident in India is permitted to buy immovable property outside India. So that purchase of property is permitted, so that can be done. Then second is, to purchase this property, she is going to take a loan, a foreign currency loan from a bank in Dubai. So now this is the second type of capital account transaction where a foreign currency liability is being created by person resident in India. So in that case, we will refer to the second regulation, which is foreign exchange management, borrowing and lending regulation. And there we will find that borrowing by person resident in India does not permit an individual who is residing in India to create any foreign currency liability or avail any foreign currency loan from an entity outside India. So here per se, taking this loan from HSBC Dubai is not in compliance with the provisions of foreign exchange management, borrowing and lending regulations 2018. So this borrowing is not in line with the provisions. So it is not a permitted capital account transaction for Mayuri Joshi. So she will not be able to carry out this transaction, even though she is going to serve this loan out of the rental income earned from aforesaid property. So this transaction cannot go through, and this purchase cannot go through. Case study 3, Mayuri Joshi proposes to purchase a residential property for USD $450,000 in UAE. Construction of the property would be completed by December 2023. So now we are in 2022. As per the terms of the purchase, she needs to remit $250,000 in 2022-23 and balance in financial year 2023-24. She would be spending approximately $10,000 on her visits abroad every year. Whether the above transaction is permissible under LRS. So now again, here, if you look at the transaction, the total value of the property is $450,000. She is required to remit $250,000 in the current financial year and balance $200,000 in the next financial year. So only thing is that, so basically whether she can purchase a property, the answer is yes. So she can carry out this. Then what will be the remittance amount under LRS? The maximum cap is $250,000. So here in year 1, that is in 2022-23, she is remitting $250,000. So that remittance is within the limits. However, as it is mentioned that she also needs to spend additional $10,000 on her visit abroad every year, obviously to execute the documents, and she will be visiting Dubai and all. So that, because she has already consumed $250,000, that additional visit will, this spend of $10,000 will require permission from Reserve Bank of India in 22-23. In 23-24, because then the balance to be remitted is $200,000, and she will be spending another 10,000. So total spend will be 210,000. So that will be within the limits of LRS. Case study number 4. Ketan Shah proposes to purchase a residential property in New York worth USD $500,000. Entire payment is to be made upfront. Whether the proposed remittance amount is within the LRS limit, and what other options does Ketan has to enable him to remit amount. So now here there's a peculiar situation where the property value is more than the limits prescribed under LRS. So here, whether a resident can purchase a property, we saw that the answer is yes. So it's a permitted capital account transaction. However, the value of the property is much more than the limits prescribed under LRS. So now if Ketan wants to purchase this property, he can remit only up to $250,000. So one more option with him is he can actually make his close relative or his wife as the joint owner of the property. So with that, he will get, or the family will get, an additional remittance limit of $250,000. So he can remit on his name $250,000, and additional remittance can happen in the name of his wife. So that way he can fulfill this payment obligation, and both of them can, so basically they can purchase this property. So in case of such purchases, the additional remittance limit for family member will be permitted. The RBI has clarified that the only condition is that that person or the family member who is remitting money should also be the joint owner of that property. So for example, if Ketan Shah wants to open a foreign currency account and he wants to remit $500,000, so, and he cannot say that, okay, I am consuming my limit also, and I'm to my wife is surrendering her limit to and giving assigning that limit to me, and I'm so in total as a family we are remitting only within the limits. So the answer is that is permitted only if that the second remitter becomes a co-owner of the property abroad, or becomes the co-applicant or a joint signatory to that account abroad. So per se, if he remains an individual owner of the property, he will require prior approval of Reserve Bank of India. But if he adds his wife as a joint owner of the property, then this transaction will go through. Case study 5. Ketan Shah proposes to open a foreign currency account with Citibank in the USA. While remitting the amount, the end use is not defined. Whether he is permitted to remit the amount without having definite end use. So now it's a plain vanilla where he's just approaching a foreign Citibank and requesting that bank to open an account, and that account is will be opened specifically for LRS purpose. And he will approach the local bank in India and request them to remit $250,000 or whatever amount he wants within the limit to this foreign currency account. So while remitting this amount, today he doesn't know for what purposes that money will be used. So whether such remittances will be allowed. So the answer is yes. So because specifically this LRS scheme permits resident individuals to open a foreign currency account and transfer money to that account with an only obligation or condition that whenever he uses that money from that account, he has to make sure that the end use of that money is in compliance with capital account transaction or current account transaction under FEMA. So basically it's being carried out for permitted capital account and current account transaction. So here the answer is yes, he can open a foreign currency account and money can be remitted even though the end use is not defined today. So Ketan Shah proposes to open a foreign currency account with Citibank in the USA. He would be remitting USD 225,000 to this account and use the same as under. 50,000 to be parked in fixed deposit with Citibank, 100,000 to purchase shares of listed entities in the USA, and 75,000 to purchase mutual funds. The above investment will be made in staggered manner over a period of 2 years. And whether the above mentioned deferred use is permitted under FEMA. So as we discussed in case study number 5, so what LRS says that you have to use that account, the amount deposited in the specific foreign currency account used in the LRS, open under LRS for permitted capital account or current account transactions, but the manner or the time, there is no prescribed time limit within which it should be used. So as long as the end use is with eligible or permitted capital and current account transaction, that deferred use is permitted. So here, if you look at the end uses, that is the money is parked in fixed deposit or purchase of shares of listed companies or purchase of mutual funds, all these are permitted uses. So the Ketan will be permitted to use this money parked in this account on a deferred use basis. Case study number 7. Ketan Shah has opened a foreign currency account with Citibank in the USA. Till now, he has remitted USD 1 billion to this account over a period of 10 years. The amount so remitted has been utilized as under. So purchase of residential property, $500,000, investment in shares, $300,000, investment in mutual funds, $200,000. Ketan has been receiving USD 100,000 income from the above mentioned assets, which is credited to the aforesaid account. So whether he is permitted to retain the income so earned to this foreign currency account. So yes, as we saw the salient features of this LRS scheme. So you are not under obligation, unlike other regulations. If suppose if from India you have raised an invoice for providing any services, and then you are under obligation to receive that money within the stipulated time period. However, if that money is being remitted outside India for any LRS purpose, and if any asset is created, and if any income is earned out of that asset, that money can be parked outside India without, and there is no requirement of bringing that money back to India. So this, he will be permitted to retain the income so earned to this foreign currency account. Whether he can use the said income for additional investment outside India without bringing the same to India, the answer is yes. So he can redeploy that into, so only what he has to ensure that the use of that money, the income which he has earned on those assets, should also be within the permissible capital account and current account transactions. Whether he can use the said limits for additional investment, answer is yes. Whether the LRS limit is applicable for the said amount, the answer is no. So any income earned and parked abroad and reinvested will not basically consume the LRS limit. Case study number 8. Sachin Sathe, a resident Indian, has made a gift of residential property valued at rupees 2 crore situated in India to his daughter, who is a non-resident Indian, in April 2022. Is he allowed to remit $250,000 under LRS in FY 2022-23? So recently this case came up. So here, if you analyze the provisions, so basically there is a gifting of property, residential property located in India to a non-resident daughter. So now, if you, so basically then we have to analyze it, whether this is permitted, whether this gifting is permitted or not. Then we have to refer to the foreign exchange management, acquiring immovable property in India by a person resident outside India. So then we'll find that NRIs are permitted to receive a gift of immovable property from a person resident in India. So technically, receiving this gift by a daughter who is an NRI from a resident Indian is a permitted capital account transaction. And here, this is just a gift of immovable property. Now, Sachin Sathe has not utilized any limit and has not remitted money outside India. Neither he has remitted money to her NRO account, or he has not gifted any money in rupee term, in monetary term to her daughter. So, in my opinion, he will be eligible to remit $250,000 because that LRS limit will not get consumed if the residential property is gifted to NRI daughter and if the property is located in India. Case study number 9. Sachin Sathe, a resident Indian, has opened a demat account with a depository participant in the USA. He has also engaged a broking firm to handle his investment. He has been making the portfolio investment within the LRS limits. Considering his size of investment, the broking firm is offering him a credit limit to deal in the securities of the US companies. Accordingly, he is availing the credit limit of USD 1 million and trading in shares. Whether utilizing the credit line from a US broking firm is permissible under FEMA. So again, we have to analyze this transaction from capital account transaction perspective. And as we discussed, that a resident individual is not permitted to take any sort of loan or trade from a person resident outside India. So in foreign exchange management, borrowing and lending regulations, such borrowing or creating a foreign currency liability by a person resident in India is not a permitted capital account transaction. So in this case, so Mr. Sachin Sathe, if he does this, that will be a violation of Foreign Exchange Management Act, and he is not permitted to carry out this transaction. Case study number 10. Mr. John Smith, a US resident, is residing in India for last 5 years for the purpose of employment. He is working as CEO of Microsoft India Private Limited. As per the provisions of FEMA, he is a person resident in India. He proposed to remit $200,000 under LRS. Advise him on his eligibility to remit funds under LRS. So while discussing the definition of person resident in India, we also saw that there is a specific category of person who is treated as person resident, but not ordinary resident in India. So PROR. So here, Mr. John Smith, as per the definition of person resident in India, he fulfills both the conditions that he has been staying in India for more than 182 days in the preceding financial year, and he has come to India for the purpose of employment. So for the purpose of applicability of provisions of FEMA, he is treated as a person resident in India. But as I said, because he is a US citizen and he has come up on a secondment and for the purpose of employment, his category will be a person resident but not ordinary resident. And to such categories, the LRS limits are not applicable. So he is permitted to remit whatever income money he earns in India, salary he earns in India, post payment of taxes without any limit. He can remit that money. However, if he wants to remit money in excess of that limit, so let's say he has already remitted $250,000, $300,000, and now he wants to remit additional money, then he will require prior approval of Reserve Bank of India. So that his remittance limit is not linked to LRS limit. So even though his person is in India, the LRS limit is not applicable to him. For him, the limit is whatever money he has earned post payment of taxes. So entire that money he can remit outside India. But that can be any amount. It can be $100,000, it can be $200,000, or it can be $300,000. And if he wants to remit in addition to that, let's say that he, after residing in India, he buys a property and now he has sold that property and he wants to remit money outside India while he is in India. So, and he has already consumed that limit, so whatever money he has earned by of salary, post payment of taxes, he has already remitted. Then any excess remittance will require prior approval of Reserve Bank of India. Case study number 11. Mr. Mahesh Sharma is the sole proprietor of Messrs. Avni Enterprises, which is dealing in electronic goods. Mr. Mahesh Sharma has utilized his LRS limit for the year 22-23. He has separate current account in the name of Messrs. Avni Enterprises and proposes to remit money in the name of Messrs. Avni Enterprises by using the current account balance. Whether he will be eligible to utilize additional limits through his sole proprietary firm, and whether he is permitted to make additional spends for his business visits. So now here, basically what we need to see is a sole proprietary firm is not a separate legal entity. And so basically then he's the owner or the sole proprietor. So the permanent account number of Mahesh Sharma remains same. There is no separate legal entity, and LRS provides all the limits of under LRS are subsumed, or all limits are given under current account rules for private visits, for business visits, or for eligible capital account transactions, or maintenance of family abroad. So all the entire limits are subsumed. So capital account, current account is subsumed in that $250,000. And now because he has already utilized his LRS limits, he cannot additionally buy foreign currency and make spends for his business visit. And if he wants to do so, he will have to approach Reserve Bank of India and get the prior approval. Case study number 12. Mr. Mahesh Joshi, a resident Indian, has utilized USD 100,000 under LRS in the month of April 2022. He proposes to give a rupee loan to her daughter, who is an NRI. Whether providing rupee loan in India to a close relative would consume the LRS limits. So again, we have to see exactly what transaction it is. So the transaction is that a resident is giving a loan, a rupee loan, to a non-resident. So we have to see whether such transaction is, so it's a capital account transaction because you are creating basically a foreign currency as an asset, or you are giving a loan to a non-resident Indian. So that this is a capital account transaction. So we have to see a specific provision under the respective regulation, which is foreign exchange management, borrowing and lending regulations. So here it is a lending by person in India. So if you look at the specific regulation in that borrowing and lending regulation, it says that a person resident in India or resident Indian is permitted to give a rupee loan to his close relative defined under Companies Act under Section 2, subsection 77. So such giving of loan is permitted. Only there are conditions attached. So as long as Mahesh Joshi fulfills those conditions, such giving of such loan will be permitted. And with respect to LRS, because he is parting away money, he is remitting, he is transferring money to the account of a non-resident Indian. it will be treated as to the extent he has consumed LRS limit. So to answer this from the capital account transaction perspective, whether giving of loan is permitted, the answer is yes, provided he fulfills the conditions, and the conditions are the loan should be interest free, it should have a minimum maturity period of 1 year, and it should be utilized only for personal requirements or own business purpose of that NRI in India, and that money is not allowed to be repatriated outside India. So as long as these conditions are fulfilled, yes, giving of this loan is within the provisions of FEMA under capital account transaction. And because the amount is $100,000, so the limit is the loan amount is also within the limits prescribed under LRS, which is $250,000. So Mr. Mahesh Doshi is permitted to carry out this transaction under LRS. Case study number 13. Mr. Mahesh Doshi, a resident Indian, has opened a foreign currency account in the UK with HSBC Bank London and has earned 100,000 GBP on the investments made through his account under LRS over a period. Mrs. Kishori Doshi, a wife of Mr. Mahesh Doshi, has also opened a similar account with HSBC London. So she also opened a LRS account with the foreign bank. Mr. Mahesh Doshi proposes to transfer JPP $100,000 part in this in his UK bank account to his wife's bank account, and whether such transfer is permissible under LRS since it does not involve any outflow of foreign exchange from India. So now here, otherwise what he is otherwise permitted, Mr. Mahesh Doshi, to use this amount for any further investment or to spend this money for any permissible capital account or current account transactions. Here, instead of doing that, instead of spending that money on any current account transaction, he proposes to transfer that money to one foreign currency account which is owned by him to his wife's account. So whether such transfer is permitted, the RBI clarifies that such transfer is not permitted. You cannot make foreign currency available to another resident Indian. So if at all he wants to bring this money, he should bring this money back to India. Then he can give a rupee gift to his wife, and then his wife will have to remit money outside India by consuming her limits under LRS. But direct transfer of this foreign currency amount from one foreign currency account to another foreign currency account is not permitted. So that's all. There were different 13 case studies under LRS scheme. I tried to capture different scenarios which are, as an advisor, came up for these queries come from the clients every now and then. So I thought let's capture those. And while studying these case studies, we'll analyze the provisions under LRS and also apply the definition of capital account, current account, and how we should analyze the foreign exchange transaction and find out how to comply with those respective regulations and conclude on our opinion on that. So that's what as far as the basic, the fundamental structure of FEMA is concerned and the provision with respect to LRS is concerned. So with respect to the roadmap to expertise under FEMA, what I feel that now, because you're going to have 8 sessions on different important topics, and I have also captured those topics in my slides and given and clubbed all the applicable regulations, rules and acts, FAQs and master directions. Try to read that before the session, so you'll be well aware of the provisions with respect to that particular topic. So define the timeline to study, to complete the study. Then all this, as I mentioned, all this information is beautifully available on the website of Reserve Bank of India. So you can make a habit of visiting RBI website on frequently, every Saturday, or you can define a day. So make sure to keep you abreast on the latest amendments. Then if you have not started practice in the FEMA, invite queries and issues from the clients. Initially, you can do it on pro bono basis and try to help. So each query will give you a lot of learning, will allow you to analyze the transaction, find out how to analyze a particular transaction, then find out what is the current account element into that, whether it's a capital account element, which exact regulation is applicable. So analyzing different queries of different clients of different verticals. One client can be from software, the other can be from manufacturing. So there are different verticals, which will give you more exposure under FEMA. So more the queries would give you more exposure to the issues, and more you'll refer to the FEMA provisions more frequently. And then last but not the least, you can also liaison with authorized dealers. attend the webinars conducted by them also, because they also give a lot of inputs on the recent amendments made by the Reserve Bank of India. What is the stand of authorized dealers? What all documentation is required? So the process-oriented inputs are basically, you can get very good input from these bankers. And then just, yes, you are good to go. So I hope you so you enjoyed this 2 hours session, and I'll just try to go through the queries one by one, and we have 5 minutes left. So just give me a minute. Okay, fine. So I try to read few queries. Can utilized LRS limit for the financial year be carried forward to next year? Answer is no. So this limit is given for a financial year. So if someone has not consumed it, that limit is gone. You cannot, there is no carry forward allowed. Is LRS applicable for minor? The answer is yes, it is possible. Only thing is that all the PAN and with respect to that form A2, the remittance documents will be signed by the guardian. In your case, state number 4, Ketan Shah, if Ms. Ketan Shah is unmarried, divorced, etc., then can he use the approval route? If yes, that approval route will be government approval or RBI approval. So if he's an individual single, he does not have any close relative and no joint signatory or will be there for the property or joint owner, then yes, the limit is $250,000. And in case if he wants to remit in excess of $250,000, then as I said, from FEMA point of view, we need to see which regulations are applicable. So this is FEMA purchase of immovable property outside India by person resident in India. So which says that in case it is not permitted or if it is beyond the limits, then you have to approach Reserve Bank of India and not the government. So the permission of RBI will be required. Could you please recommend a practical handbook on FEMA? So there are a lot of books actually. Even as I said, RBI website is so beautifully crafted that all the information is available once you go through master directions. So as now with this session, you know what is the flow. There is an act, there are regulations, there are rules, and there are then APDI circulars, there are master directions. So once you read a master directions, go have a reverse journey and then go through the respective APDI circular wherever the amendment has taken place. You can go to the respective regulations. So you can go back and forth, go through the regulations, then read the master directions. So I think even RBI website is beautiful. All entire information is available over there. The RBI MD on LRS says it is only for resident individuals, but the 4th proviso to Schedule 3 to current account transaction rule says it is not available for non-individuals. Also, should not the rules prevail over the master directions? So basically, the LRS scheme, it is for resident individuals. It is clearly mentioned that it is not applicable to a person resident in India other than resident individuals. So obviously, it is
only the master direction says that, Mr. Nanal.
Yeah.
The master direction says it is available only for resident individuals. But
right.
But the FEMCAT rules clearly say it's available for non-individuals. If you look at 4th proviso to the Schedule 3 of FEMCAT rules.
Right.
Mutatis, it's available to non-individuals, it says. So my question is, should not the rules prevail over the master direction? Because master direction is administrative, rules are subordinate legislation, no?
Yeah, that's true. But see, on FAQ also, RBI has clarified their point. So basically, I think the position of RBI is very clear on this, that the limits are applicable. So if you want to miss from interpretation perspective, yes, what we are saying may hold good. But the RBI has clarified its viewpoint on this. And so in my opinion, if the LRS per se will be limited only to the resident individuals.
So what happens to the 4th proviso to FEMCAT rules? It is non-operative.
No, so basically for other entities, they are permitted to carry out current account transactions within the limit prescribed, right? So if there is a donation, if an Indian company wants to give donation, if it's not fulfilling those criteria given under Schedule 3, then it will have to approach RBI and get approval.
No, that's my whole question. Can an oversight in a master direction render a rule negatory and non-operative?
I accept your position actually. But what I'm saying that as we know the viewpoint of RBI, Even if you approach authorized dealer and if you say that, okay, we are an entity and we are remitting for this purpose and we want to consume LRS limit, they will not permit you to do so. That's what I'm.
What is needed is a clarificatory amendment of the FEMCAT rules.
Right, absolutely.
So that there is no conflict between the two.
Yeah, that's true.
Okay, thank you.
Thank you. So in case of foreign loans, the loan amount would be capital account transactions. Yeah, obviously, the foreign loan create a foreign currency liability. It is, as if you look at the definition of capital account transaction, it will attract compliance of foreign exchange management, borrowing and lending regulations. So yes, so you can carry out foreign currency loan transaction only if it is permitted. And from LRS perspective, individuals are not permitted to raise any foreign currency loan. So, or to give any foreign currency loan. So that transaction will not be allowed under LRS. So I think now we are 6-1. So I'll just stop over here. And yeah, thank you everyone for this opportunity.
A wonderful lecture, Sunilji. It was very good.
Sorry, I was a bit fast. I was a bit fast because I thought I may not consume complete all entire whatever I prepared. So I was little fast. So my apologies for being little fast. Yeah.
I think, but with 2 hours of time, the best it could be covered, you have covered in that. And with the practical examples on LRS, because when we think of LRS, we think, oh my God, it's very easy. Capital and current, it's very easy. But when we get to implement it, as Venkateshan sir also would agree with me, when you get to implement it, then you realize that it's so complicated.
So complicated.
Congratulations, Sudhaji, on your latest book. I'm waiting to read it.
Yes, so very thanks. Yes, sir.
So basically,
I not yet received it.
Yes, it will be coming, sir. It was in pre-booking stage till now, but then yeah, it has started to be dispatched.
I saw an announcement in the chat box of the FEMA group, FEMA course which you addressed sometime back. In that chat box, I saw, and that FEMA group, I saw the announcement, but I have not seen the book yet. All the best.
Yes, thank you, sir. So as Sunilji was saying something, it was
yeah. So while analyzing LRS, so I just realized that basically that's the only I would say that provision which covers entire gamut of FEMA, because it says permissible capital and current. You need to know all the permissible capital and current, because otherwise, for let's say you are studying ECB, you just stick to ECB guidelines and just you can conclude. But a LRS, and that too you are advising an individual who does not have much knowledge of FEMA or much is not mature enough. So, and they end up doing all such transactions. So I think it's more challenging to deal with LRS transactions.
Yeah. Absolutely.
It was a very good presentation, Mr. Sunil.
Thank you, sir. Thank you.
Thank you, Sunilji, once again. And thank you all the audience for being here with us. And tomorrow we again have a session for the continuous 8 days. And thank you for joining us. Sunilji, thank you once again for your time. It was a fantastic presentation.
Thanks a lot for the opportunity. Thank you.